This is what happened when Adam tried to teach himself to golf. When he tried to teach himself Kung Fu. And when he tried to teach himself to cook. Careful, babe. So when Adam wanted to learn a tap dance, he decided to mirror an expert. That's why when it comes to learning to invest in the stock market, Adam uses the new Mirror Learn and Trade platform on Bursa Marketplace. He just needs to register, choose from a selection of analysts to mirror, learn how they manage and strategize their portfolio, and mirror. With 100,000 virtual ringgit. Sign up on BursaMarketplace.com. And just like Adam, you can start your investment journey today.
Good evening, everybody. Welcome to our webinar brought to you by Kenanga Investment Bank, titled F&B Stocks Powertalk. Okay, welcome everybody. This webinar brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia and managed by our company, Wealthfort. My name is Shen Chu. I'm moderator for today's session. So welcome everybody. So if you can hear us and see our screen, see our webcam, please comment in the Q&A box to let us know where you are tuning in from. Okay, let us know where you are coming from. If you can hear us, see our webcam, and also see our slide.
Shane, you want to actually like lower down your microphone?
Oh, is it? Yes.
Yeah, it's a bit soft.
Oh, okay. Sorry, I forget that I did not take the microphone down. All right. Okay, cool. So let me repeat our intro. Okay, welcome everybody to the F&B Stocks Powertalk brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia and managed by our company, Wealthfort. So as I have just play a video for you, which is a Mirror Learn and Trade. So Bursa Malaysia offer this, Bursa Marketplace offer this service, Mirror Learn and Trade. You can go to the website Bursa Marketplace and click Mirror Learn Trade. You'll be able to mirror from all the analysts that are approved by Bursa Marketplace about their trading strategy. So you can go there and mirror some of the analysts, licensed analysts trading strategies. Okay. So this is where what Bursa bring to you, the Mirror Learn Trade. Okay, so now I think the sound is okay. If it's okay, let me know. The sound is okay.
Yep, it's okay.
Okay, perfect. Thank you so much. All right, so yeah, today we have a very exciting session, which is titled F&B Stocks Powertalk. So like the name suggests, in this webinar, we're going to delve deeper into studying the consumer staple stock and F&B stocks. Okay, so before we go on further, this is usual disclaimer, and whatever that is discussed on this webinar is only for educational purpose. In no way that we give any buy or sell signal to any companies that we do case studies on. So in the event that you want to invest or you want to do any buy or sell trading decisions, you do it at your own risk. Okay, so neither the Kenanga Investment Bank or Bursa Malaysia nor our company Wealthfort and the speaker are responsible for all your financial decisions. So this is the disclaimer. Now for Q4, finally we are coming into the Q4 for this Kentrade webinar. In the Q4, we still have a series of webinars for you. So as you know, September is the end of Q3, but then we also plan the Q4 webinar for you. So on the 13th of October, we have a session with Derek Tan. Due to popular demand, we are deciding to bring him back for another session of technical analysis, which is titled How to Profit from Chart Patterns in Malaysia Stocks. And then on the 22nd of October, Thursday, we have a market outlook session in the Mandarin with Kenanga Research. Then on 26th of November, we have a session with Mr. David Poh on portfolio timing. And on the 15th of December, we have a session with Kenanga Research, Head of Research, Mr. Koh Huat Sun, on the Malaysia Market Outlook 2021. So this is the Kentrade Webinar Q4 Q4 series in store for you. So if you're keen, please reserve this date, block this date in the calendars, and then remember to register when the registration comes online. So allow me to introduce you the speaker for today. So he's also a friend of mine. So he's the content producer of kclau.com. If you closely follow kclau.com or any other financial website, chances are you may bump into his articles. So he's a content producer for many of these financial services company. So he has written about 100+ articles on kclau.com. He is a regular webinar host and a presenter. He is also the co-founder of dividendvault.com, and then in which they manufactured competent dividend investor who can build dividend paying stock portfolio in Malaysia, Singapore, and Hong Kong independently. So he is also a dividend investor himself, invests primarily for dividend income, yielding about averaging 4 to 8% in dividend yield per year. So without further ado, let me introduce to you Ian. Let me hand over a session to you, Ian, so that he can proceed with his talk. Okay, Ian, are you there?
Yes. Hi, Shane.
All right, cool. So I'm making you a presenter right now.
Yep. So I believe everyone is seeing my slides, right? Shane?
Yes, perfect.
Yes. Yes, perfect. And once again, thank you so much, Shane, for inviting me onto this show, onto this platform. And once again, thank you so much, Kenanga, for hosting this. And it's such a privilege of mine to be here today to actually share a little bit about myself and what I do, and more importantly, my journey as an investor on this platform. So I've prepared a lot of materials, and let's just get right into it. Okay, so today we are going to just focus on F&B stocks. Okay, and basically over here I have just summarized 5 different reasons of why people, especially investors, all right, because if you think about it, right, there are plenty of players in the stock market. We have investors, we have traders, speculators, gamblers. We have all kinds of people buying and selling stocks for very different reasons, but I can't say for all. I'm just actually going to speak on behalf of investors, all right, people who buy into the business. So basically I can actually summarize 5 different reasons of why people may want to invest in F&B stocks, and they are as follows. Number 1, normally, right, apart from if you want to compare with other industries, right, F&B stocks, they are more or less viewed to be very defensive, simply because in good times, bad times, or even COVID-19, right, we can't go hungry, or we can't actually go thirsty. People need to eat and drink, all right? It doesn't matter what the economic condition is. People just need to have food lah. People just need to put something into their body so that we can actually live on. So this is and because of that, right, that's why it is deemed to be defensive, simply because it is something that is a necessity to all of us, and people are willing to spend money on it. So that is the first reason why I believe investors would like to actually have some F&B stocks into their portfolio. But currently, I don't have any F&B stocks in my own portfolio at this moment. But who knows in the future, all right? So this is actually also a session where I'm going to share with you how I actually personally look into these F&B stocks. But that one comes later. So let's get into the reason number 2. Reason number 2, the business model. Okay, so there are many stocks in the stock market, all right? But if you are talking about F&B stocks, right, the good thing about F&B stocks is that the business model, it's actually easily understood and easily visualized by the general public. So you don't need a PhD or a or you don't need to be a technical expert in a certain industry to understand how F&B stocks actually work. All right. So for example, if you are looking, let's see in my slides, we have popular brands like Milo, Nescafe, Carlsberg, Heineken, and all this kind of stuff. You can actually have you can actually visualize how these things are actually being made. What are the more raw materials you need? All right. What is the raw materials you need to produce, let's say, a can of Milo? All right. And then after you have produced the can of Milo, where does it go to? Maybe it will go to, let's say, Aeon. All right, Aeon big supermarkets, or even small kedai runcits actually for sale. All right. Or in fact, some of these Milo cans, right, will go into some other places for sale. Who knows? All right. And of course, the people who actually buy them are consumers like you and me. All right, for our own personal consumption, or they can actually be sold to, let's say, a restaurant, or any F&B outlet, right, where you can actually go to their restaurant and order a Milo Ice or a Milo Dinosaur for consumption. Okay, so it's actually not too hard to understand all these businesses. So that gives actually the investment community an opportunity, or an advantage, I would say, not an opportunity, it's an advantage over the other stocks like oil and gas industry, or industrial products, or maybe technology stocks, which, if let's say I'm not an engineer, or I'm not such a techie as a person. So if you want me to invest in a technology stock that is dealing with, let's say, certain kind of where it requires me to understand certain kind of specialized knowledge, then I will know. All right, then I will not know how to assess the business model. I will not know how to value the stock, simply because I do not know myself. I do not have the technical knowledge to understand this kind of stocks. All right, because I'm not such a technical person. All right, and with that said, of course, reason number 3, I have already expounded on it, which is popular brands. All right, as you can see, Milo, Nescafe, Carlsberg, Heineken. It is actually a relatable brand to all of us. All right, all of us will have a general idea of what these brands are. But if, let's say, for example, if you're talking about other stocks, let's say, for example, I talk about Dialog. All right, so let's say, for example, if you're not in the oil and gas industry, you may think that dialogue means I'm now having a dialogue with you, right? All right, it couldn't have possibly tongue twisted. It couldn't possibly have other meanings than just having a conversation. All right, but for people who are in the oil and gas industry, or people who are in the investment community, maybe they know, oh, Dialog Group is actually an oil and gas company. All right, so which means to say, what I'm trying to say is this. Okay, these are brands that are widely known by people, and because of the network of people, because it's more known by people, people tend to actually buy, or actually be, how would I say, pay attention to these stocks over other stocks which doesn't have a brand resemblance in their name, like Dialog. Even if, let's say, for example, today I'm going to talk about another company. Let's say, let me give a company. Let's say Dufu. All right. So people who are not into technology may not know what Dufu is, or Globetronic is, or Vitrox is, all right. So this is actually the key advantage of F&B stocks over other companies, simply because they are popular brands itself. The fourth reason is because of finances. As you know, F&B stocks, they actually generate a lot of cash sales, and if you look at their financial records, most of them have very little debt, if they have any, or they have very little bad debt. All right, they have very low capital expenditures, and more importantly, they have very high dividend payouts. So this is why some investors may want to actually include F&B stocks into their portfolio, because of their ability to generate dividends. And last but not least, if you want to actually achieve some capital appreciation, all right, you need more participants with bigger money to actually buy into all these F&B stocks. So F&B stocks, the good ones, they tend to have bigger investors coming in to invest in these companies. So this will include pension funds like EPF, Tabung Haji. Is Tabung Haji a pension fund? But anyway, Tabung Haji has a lot of money, so they can actually be an investor. Insurance companies like Great Eastern, Prudential, AIA, mutual funds like Public Mutual, and all the mutual funds that you can think of, they have a lot of money. And if let's say, for example, they want to invest in something which is more defensive, then they will come into F&B stocks. So that also explains why F&B stocks, the stock price, right, tend to be a little bit more defensive, a little bit more less volatile as compared to others. All right. But of course, with that said, let's not take it to the bank. Let's move on. So after I have actually, so just now I've just explained, just share with you the 5 key reasons of why investors may want to consider F&B stocks and put it into their portfolio. Now I'm going to share with you 2 simple steps. So let's say, for example, today, if you're an investor and you want to invest in the F&B stock, so how do you actually start to invest in a typical F&B stock? So here I'm going to share with you just 2 simple steps. All right, and the 2 simple steps, right, is actually answer 2 simple questions. The first one is, what kind of F&B stocks would you like to buy? And then the second question is this, at what price do I buy, right? So these are always the 2 questions, what to buy, what price to buy. So let's start off with the first one. So if you look at what to buy, basically, I've actually did a little bit of research, and I find that there are about 15 to 20 stocks listed on Bursa Malaysia, where it is actually dealing with F&B manufacturing. All right. So this will include famous brands like Heineken, Carlsberg, Nestle, Ajinomoto, F&N, Power Root, Hubsync, Apollo, Coca-Land, Dutch Lady, Oriental Food, and of course Spritzer. So as you can see, there are so many choices out there, but what to buy? So how do you actually segregate? How do you actually filter out the good ones from the not so good ones? So with that, you need to look at 3 things: the past, the present, and the future. So the first one is the past track record. All right. So of course, the ones that have stellar or better financial results in the past will be the one which is more preferred. All right. And of course, by that past results, some people say, okay, past results doesn't actually guarantee future results. So what you need to look at is the present financial strength. Why do you want to look into this? Simply because if you have a company that has cash, number 1, it can tahan COVID-19. Number 2, if it has cash, it can actually invest for expansion. All right. And when it comes to that, that's why we look into the future. So if it has money to invest, where would the company invest the money? So this is where we want to look into its future growth initiative. All right. So these are the 3 things: the past, the present, and the future will answer question number 1, which is what to buy. And then we move on to question number 2, at what price to buy? So for me, I will use 2 simple valuation ratios, which is number 1, PE ratio, where we're going to compare the price to its earnings, and number 2, dividend yield, where we're going to compare its the stock price of the F&B stocks with its dividend yields. All right, from there you can actually gauge which of these F&B stocks, the good quality ones, are worthy to be considered for investment. Okay, so with that, we are going to do some live demo, and let's get right into it. So for this particular F&B Power Talk, right, I have actually prepared a spreadsheet, and I'm going to just demonstrate how you can actually do all these things within 10 minutes. Very simple. Okay. So first and foremost, right, you need to actually prepare a spreadsheet like this, where you can actually get where you need to have, let's say, a few datas. For example, starting from revenues, shareholder earnings, operating cash flow, dividend payments, EPS, which is earnings per share, dividends per share, and the stock price. Okay. So over here, I have purposely left it empty because I'm going to do a live demo with you to share with you how you can actually get this information. And with that, so this is Carlsberg, by the way. All right, I should actually start off with the introduction of the company, which is Carlsberg. And later we're going to do Heineken, Ajinomoto, and Hubsync. All right. So here I'm going to just start off with Carlsberg. I got all the details except for the latest 2019 figure. And by the way, there is a reason why I compile 10 years. All right. The reason why I compile 10 years is simply because a lot of things can happen in 10 years. Number 1, in 10 years time, right, there will be times where economy is good and there will be times where economy is bad. So what I want to see is that whether or not this company can make profits during both good and bad times. So this is, to me, very important. All right. And of course, during both good and bad times, I want to see whether or not this company can bring in the cash flow and can pay out dividends. Okay. So this is the So this is why I look into things at not at a 3-year angle or 5-year focal point, but at a 10 years focal point. So with that, let's start off with filling in the blanks, where we are going to start off with 2019. So let's go to Bursa Malaysia website. So go to company announcement. All right. You know what? I'm just going to start all over again. Let's say, for example, you do not know lah. Okay, you do not know how to find the annual report of. You need the annual report of Carlsberg. So if you do not know how to find, right, just type Bursa Malaysia, and you will be landing in the homepage. So from here, right, click onto company announcement, which is located at the top right corner of your screen of the page itself. At category, just click onto annual report, and of course, company, just type in Carlsberg. And you should be given the latest annual report from 2019 all the way down to 2002. So you have a lot of information, a lot of things that are very, very useful in Bursa Malaysia website. So please visit it if you're an investor. So click onto it. Now you can actually open up the annual reports. But typically, the financial results will be usually you see, an annual report, right, has a lot of information, but the financial results, right, are always at the center of the annual report. So I'm going to just go into part B, which is over here. I'm going to scroll down and show you the income statement, which is what I'm looking at right now. So this is the income statement of Carlsberg. So what you need to do is just compile this figure, which is revenue. Okay, so as you can see, the revenue is 1982342. 1982342. So just copy and paste, all right, onto your spreadsheet like this. And for 2019, it's 2256581. 2256581. Okay. And then next, what we are going to do is that we are going to do shareholders' earnings. So shareholders' earnings, what you can do is that you go to profit attributable to owners of the company, and just copy this figure, 27715, 277,154, and we have 291,024. And it's that simple, okay? And now we are going to move on to finding out the operating cash flow of Carlsberg. So operating cash flow is actually very important to me because I'm a dividend investor. So in order to find a company that pays dividends, right, you need to have a company that is bringing in consistently positive operating cash flow. So over here, what I will do is that I'll go to statements of cash flow. And what I see right now is that we have the 2019 and 18 figures. And all you need to do, right, is just to compile this figure over here, which is net cash generated from operating activities. And over here, I see 378,953. Just take the figure and just put it in over here. And once again, it's 378,925.
Ian, can you can you zoom in into an Excel when you do the Excel, because sometimes the font is too small.
Too small.
Yeah.
Okay, so I think I'll just
yeah.
Perhaps right now. How about this?
Yes,
will this be
this
okay?
is perfect.
I mean,
this is perfect.
Okay lah. So this is all right. Thank you so much, Shane. Now let's continue on with what dividend payments. Okay, so this is actually very important. Operating cash flow. So this is how much the company generates from its sales of alcoholic drinks. All right, all the Carlsberg beers and stuff like that. And once they collected the cash, once they collected the cash from their customers, they take the cash and they pay their employees, their suppliers of the raw material, the distribution, etc., the administrative costs. So whatever is left, right, is called operating cash flow, and from there they will pay dividends. All right. So where to get the figures for dividend payments? You can actually find it at cash flows from financing activities, which is found in the first line over here. Dividends paid to owners of the company. So just take this. So just take this figure, which is 344,578, and put it into the spreadsheet. And over here we have 311,557. 311,557. There you go. That's it. And now we are going to go into earnings per share and dividends per share. So earnings per share, you just go back to the statement of comprehensive income, or the income statement, where over here at the last line over here, you can see that it says basic earnings per share. So take that figure, which is 90.65, and just put it into your spreadsheet like this. 2019 is 19.18. And then we have dividends per share. So dividends per share, I'm going to cheat a bit because we only have 1 hour. All right. So what I'm going to do is that I'm going to cheat, whereby in Carlsberg's annual report, right, there is such a thing called management discussion and analysis, where it will give you the figure for 5-year dividend, and it's already stated here is 100. All right, dividends per ordinary share. So it says 100 and 100 over here. I'm going to just put it in 100, 100. Now, when it comes to stock price, it can be a bit tricky. All right, so let me just see. So fortunately for Carlsberg, they have actually given the figure, the last trading price as of 31st December 2018 is 1968. So I'm going to just put that in. So which means to say, exactly at the point of 31st December 2018, the closing price for Carlsberg is 1968. And for 2019, the closing price of Carlsberg is actually 29 ringgit and 40 cents, which is over here. So I'm going to just copy and paste this into my spreadsheet. Okay, so this is how you actually compile the information from the annual reports. So now you got a nice looking template like this. And of course, it's a lot of figures. So how do you make use of it? So the first thing to do when it comes to assessing an F&B stock, right, is to calculate the compound annual growth rate of all of these F&B stocks. Okay, why? This is because, right, we don't just want to buy into a company and just earn a very static amount of dividends. We want to make sure that the company that we buy has the ability or has the track record of consistent growth when it comes to its sales and its profits. So how do you measure sales and profit growth? Therefore, we need to use CAGR, or compound annual growth rate. And with that, what I'm going to show you is a trick. All right. It is to calculate the CAGR. It is to calculate the CAGR of sales and profits of Carlsberg. All right. So as you can see, just go to cagrcalculator.net/result, and you will get a CAGR calculator. So all you need to do is just very simple. Number one, as you can see, let's start out with sales. As you can see, the sales figure, right, for Carlsberg has increased from 1.37 billion ringgit to 2.27 billion ringgit. And what I can see is that in these 10 years, right, it has been consistently growing. All right, so this is actually a positive sign. So this is the type of stocks that you can use to calculate CAGR. All right, but why over here it says 9 years? Simply because the first year, which is 2010, will be the base year. So this is like after 1 year, 2, 3, 4, 5, 6, 7, 8, 9. All right, so therefore it is 9 years CAGR. So the calculator requires us to input the starting value, the ending value, and the number of periods, which is 9. So the starting value will be the sales figure at 2010, which is 1,368,158. And then the ending value of Carlsberg sales will be 2,256,581. Click onto the button calculate, and over here we can see that, oh, Carlsberg has increased its sales at a compound annual growth rate of 5.72% per annum. So just put it in 5.27%. Okay. So if you know how to calculate CAGR, you can actually use this formula, right, and test it out on the stocks that you want to invest. Doesn't matter whether it is F&B, it can be any stocks that you want. Do it for 10 years, all right, and then calculate the CAGR. For me personally, if I find that the stock has no CAGR, I don't prefer it lah. I don't prefer it to invest into it because I prefer companies that have CAGR. Now, let's look at shareholders' earnings. So as you can see, shareholders' earnings have been increasing on a consistent basis for the past 9 or 10 years. So this is the kind of stock that you can use to calculate CAGR. So I'm going to just input this. The 2010 earnings will be 133,242. So it's 133,242. The shareholder earnings is 291024. Number of period is actually 9 years. So you click on to calculate, and there you go. It says 9.07%. So which means Carlsberg has actually grown its profits at a compound annual growth rate of 9.07% per annum over the past 10 years from 2010 to 2019. Yeah. Okay. So this is actually a very good trick for you to actually find out whether or not the company has a past record of growth. Okay. And of course, you can do the same thing with Heineken. All right. Whereby it is also the same 10 years. You can actually take, let's do a comparison between Carlsberg and Heineken. So I'm going to take, let's say, Heineken figures of revenues, which is 1467575. The ending value of this, the ending value will be 2320249. Number of periods 9 years. So you'll find that Heineken, right, has increased its sales at a rate of 5.22%. All right, and let's look into the earnings for Heineken. So for Heineken, right, we can also do the same. We can take 185,486. The ending value is 312,968. Number of period 9 years. Click on to calculate, and there you go. So it says here 5.98%. So what that means to say is that based on this, Heineken has grown its earnings at a rate of 5.98%, but Carlsberg has been growing at a rate of 9.07%. So in terms of peer-to-peer comparison, I would say Carlsberg has a slight edge when it comes to CAGR of its earnings growth as compared to Heineken. So this is how you use CAGR. All right. Now, of course, you can actually use over here in this spreadsheet, I have actually included Ajinomoto and Hubsync, and there's a reason for it. So Ajinomoto, what I would like to share with you is this. This one, I think you know how to do it already, so I'm going to just skip this. For shareholders' earnings, all right, as you can see, the earnings have actually grown steadily.
Would you want to zoom in further or not?
Zoom in further.
Yeah, so people can see clearer.
Okay, so as you can see over here, the shareholders' earnings, right, for Ajinomoto, over here there's a jump, and then after that it kind of like normalized. So maybe in this situation, you may want to ask, you may have a question like this. Ian, can we use CAGR on this company? Well, it depends. Depends on what causes the jump in the earnings of Ajinomoto in 2017. So over here, I find that, okay lah, for Ajinomoto, right, they have a piece of land where they hit some jackpot lah, simply because the land, right, the land that Ajinomoto used to have, all right, the government wants to build the MRT line on top of it. Therefore, it's a force to the government. So therefore, they have a windfall from the sales of the land. And because of this, right, all right, they can actually record 187 million ringgit in earnings. as compared to the previous year of 41. But if let's say if you exclude the jackpot gain or the windfall gain, all right, basically the earnings, the shareholders' earnings, right, has it will be normalized to 42.6 million ringgit only lah. So if it's, so here imagine this is 42, then it's on a growth trajectory. So I would say yes, you can use this company to calculate CAGR, no problem. Now, if you look at Hubsync, all right, now you may ask, can you use this stock as a, can you calculate CAGR for this stock? Well, let's see. So here we see that Hubsync has a period of growth in terms of its earnings from 20 over million to 55 million ringgit, all right, in 2015. But ever since then, it seems that every year after that, every year subsequently, right, the earnings have kind of like declined over time. So in this case, I would say this is not the company. I wouldn't say you can use this CAGR. It doesn't make any sense, all right, simply because the company has recorded decline in earnings over the past 4 years. So therefore, you can say that Hubsync has, you can't actually use CAGR calculator for this particular stock lah. Okay, and therefore I wouldn't say the earnings have grown, but rather I would say the earnings have declined. Okay, so this is how you do peer-to-peer comparison among the F&B stocks. Okay, now with that covered, let's move on. I'm going to go back to my slides. So this is, so based on the past financial results, you can actually use this, and you can actually take this and just do your peer-to-peer comparison. And after that, very soon, from the 20 F&B stocks, right, you will be left with like maybe a pool of 5 to 8 stocks that you kind of like fancy lah. All right. And of course, future growth plans, right? This one you can read it in the chairman's statements and the press releases given by all the F&B stocks. All these things can be found in the Bursa Malaysia website. So now I'm going to just dive straight into the valuation, which is whether or not this is is this a good time to buy F&B stocks. So to do that, let's do a peer-to-peer comparison between Carlsberg and Heineken. But let's start off with, let's do as much as we can, starting from Carlsberg. Okay. So now over here, I'm gonna, let's see the current stock price of Carlsberg. Of course, you can use Google Finance because it's very convenient. So over here, what I see is that Carlsberg, right, at current price is 20.92. So I'm gonna just take the, I'm just gonna put in 20.92. Now here's a trick that I would like to share with you guys. As you can see over here, we can see that Carlsberg, right? Yeah, the stock price has gone up, come down, gone up, come down. But overall, it actually, over the long term, it tends to goes up. All right. So what you can do is that you can actually compare the stock price movement of Carlsberg with the earnings growth of the company. So you can actually take this. All right. Take the 10 years earnings like this, and you can just draw a chart. Let's look at the bar chart. I like bar charts better. Okay, so the chart is a bit big. So as you can see, what you see here is that the earnings have actually grown steadily for the past 10 years. So if you see that the pattern, the profit pattern actually grown like this, you may actually compare it with the stock price movement. And overall, in the long term, the growth in the earnings of Carlsberg has led to the growth is actually in tally or in tandem with the growth in the stock price. All right. So this is why I like to buy stocks with CAGR. Okay. This is the graph. Okay. So for convenience sake, what I will do is that I would actually like to compile. I would like to how would I say, calculate the current valuation ratios. I'm going to start off with the current valuation ratios. Start calculating that, and then I will compare it with the past. So here I'm going to share with you how you can do that. So basically, we're going to start off with the PE ratio. And then we'll move on to the dividend yield. Let me just center this. Just give me a sec. Where is it? Okay, done. So let's start with PE ratio. So PE ratio is very simple. The formula is like this. So you take the current stock price, which is 20.92, and then the latest EPS is 95.2 cents. So what you want to do is that you want to actually divide by G16, but this figure is in cents, so you need to like times 100. All right, because there is a ringgit cent conversion. So currently the PE ratio of Carlsberg is 21.98. All right, and this is based on the last year's earnings of 95.2 cents. All right, the current PE ratio is 21.98. Yep. And right now we are going to look at its dividend yield. So dividend yield is like this. So last year, Carlsberg actually paid 1 ringgit in dividends. Today, you get a chance to buy it at 20.92. Okay, so this is cents. So I'm gonna just divide by 100. Click on the percentage. So therefore, right now, assuming that Carlsberg is gonna pay out, is gonna continue to pay out 1 ringgit in dividends per annum, and if you buy it at 20.92, your dividend yield is 4.78%. Now, knowing the current PE ratio and the current dividend yield, it's not exactly super helpful because it's just the current. What you want to do is that you want to know whether is Carlsberg at 22 or PE of 22 and dividend yield of 4.78%. Is this a good buy or not? So with that, we need to actually compare it with the past. So how do you compare it with the past? Well, we are going to just quickly do the past PE ratio and dividend yield calculation so that we can actually make a comparison. So how do you calculate the past PE ratio? So this is the figure for 2010, which is 632. So we take the stock price, the closing stock price of Carlsberg as at 31st December 2010, which is 6 ringgit and 32 cents, divided with earnings per share, which is 44 cents. So it's supposed to be RM 0.44. So I'm gonna just divide by G4 and divide again and multiply by 100. So the PE ratio is at that time is 14.36. And all you need to do is just pull it down like this, and then you get the past PE ratio of Carlsberg for the past 10 years. Now let's do it for dividend yields. Then later I'll show you how to interpret all these figures. So for dividends, you just need to take the dividends as at 2010, divide it with the stock price, the closing stock price as at 2010, which is 6.32, divide by 100 because of the cent RM conversion. Click on the percentage, pull it down, and there you go. Okay, so now how do I interpret this? So is this a good price to enter? Is Carlsberg at PE ratio of 22 a good buy, a good deal at the moment? Now I'm gonna just include this 10. So Google Spreadsheet has a very good feature whereby, how do I get this? It's too small. Wait, let me find there's a button like this. It says here sum. Okay. So over here, you click onto this right at the Google Spreadsheet. You can see that the lowest PE ratio for Carlsberg is 14.36. The maximum is 30.89. And the average PE ratio is 19.82. So ideally, from an investor's point of view, what I would say is this. If Carlsberg's PE ratio is trading at 19.82, to me, this is actually fair valuation, which means it's not expensive or cheap. All right. So as an investor, my ideal, my own preference is this. I would prefer to buy Carlsberg if its PE ratio is actually below 19.82, or better still, if let's say the PE ratio is inching closer towards 14.36, because this is the lowest. And I will avoid buying into Carlsberg if the PE ratio is at 30.89, because it doesn't make sense. All right, it doesn't make sense to buy Carlsberg at 30.89 because it's already overvalued. All right, in fact, that is actually a better time. If you want to sell, you can sell it at 30.89. All right, so right now, based on this, the PE ratio is now 21.98, which is slightly above average. So which means that if you buy it now, it is slightly above its fair valuation based on the PE ratio at the moment. Okay, so this is how I interpret things. Now moving on to dividend yield. So how do I actually interpret, is 4.78 a good deal? So the same thing, I'm gonna just include the 10 past dividend yield, and let's find out the answer. Where's the button? Okay. So I'm looking for this button over here. All right, as you can see, as a dividend investor, I would love to buy Carlsberg if it can give me the maximum dividend yield, which is 6.07%. All right, that makes sense because the higher the yield, the better. I will avoid buying into Carlsberg if let's say the dividend yield that is giving me is just 3.01%. That doesn't make sense because I'm actually a dividend investor. I want to get higher dividend yields than FDs. All right, so it doesn't make sense to buy into Carlsberg if its dividend yield at the time is paying me only just 3%. So let's say if it's fair value, which is not too expensive, it's not exactly the best deal in the world, but not the worst deal in the world also, then the average dividend yield is 4.82%. Okay, so to me, 4.82 is just a so-so deal lah. So right now, what I can see is that the dividend yield for Carlsberg is 4.78%, which is just 0.04% short of this 4.82%. So to me, 4.78% is kind of like a so-so deal lah, all right, because it's very close to the average. Okay, so this is how I use valuation ratios, right, to actually guide my own decision on whether or not I should invest or not to invest into a certain stock. So this is how I do it. All right. So now I'm going to just compare this with Heineken because we're going to do a peer-to-peer comparison. So I've done all that is necessary over here. So we are going to just copy and paste. And then from here, we can actually find out whether or not which of the two stocks is more expensive or cheap. All right, or are they around, or are the deals around the same? So I'm going to use their latest earnings per share figure as well. So let's take a look at Heineken's stock price. So currently Heineken's stock price is 21. So Shane, is there a way that they can actually vote?
Vote. Okay. Let me customize a poll right now.
Customize a poll. So actually for
Heineken or Carlsberg, right?
Yeah. I mean to say, let's do a vote lah. Who will actually buy Carlsberg and who will actually do Heineken lah? While I continue on this presentation lah. So right now we kind of like know where Carlsberg is right now. So now I'm gonna just calculate the same thing for Heineken and see which one is actually a better deal lah. Okay, maybe so if the poll is ready, then just participate in the poll. So let's continue. So likewise, we have PE ratio. Let's make this into center. Of course, if you have any questions, just feel free to put into the chat box, and both myself and Shane will be more than happy to actually address them right after this particular webinar. Okay, so how do you calculate the current PE ratio of Heineken? Once again, you can take the current price, which is 21, and then you just divide it with the PE, with the earnings per share. But the earnings per share is actually in the figure of cents. So what you need to do is just divide it with I16, and then you have to multiply it with 100. So the current PE ratio of Heineken is 19.44. Okay, and for current dividend yield, Carlsberg has paid, Heineken has paid out 1 ringgit and 8 cents. Okay, 1 ringgit and 8 cents. And then we have to divide it with the stock price, which is 21 ringgit, divided by 100 due to the RM cent conversion. So right now, what I can see is that, hey, Heineken is paying 5.14% in dividend yields. If let's say it continues to pay out 1 ringgit and 8 cents to its shareholders. But of course, before we actually find out whether is this a good deal or a bad deal, we need to actually compare it with its past valuation ratios. So starting off from 2010, what we can do is that we can take K4 divide by K4 is the stock price. We need earnings per share, which is I4, multiply by 100. So this is the past PE ratio for Heineken. And then I'll do this for the past 10 years. So this is the 10-year result. And let's do the same for dividend yields. So we're going to take the dividends per share, which is 45 cents, divide by the stock price. All right, divide by 100. Put a percentage on it, scroll down. Okay, and there you go. Okay, so right now, this is actually very interesting. So how do you actually interpret this? And as you can see for Heineken, right, there is one very odd line over here. So how do I actually interpret this? So here, for 2016 figures, it's actually for an 18-month period, starting from 1st July 2005 to 31st December 2016. So if you want to do this conveniently, what you can do is, okay, what you can do is that you adjust it to, you annualize it back to 12 months, because you know that the figures for earnings per share and dividends per share is for a period of 18 months. So what you can do here is that you can divide by 18 and multiply by 12. Or I should say, you should multiply by 18 divided by 12. Yep. So this will be more like it. So that's how you actually normalize the results from 18 months to a 12 months financial results. And whereas for dividend yields, what you can do, you can also do the same. You can divide by 18 and multiply by 12. So this will give you a dividend yield of 6.09%. And with that, let's compare the past valuation ratios of Heineken with its current valuation ratios. So for Heineken, the current valuation ratio for PE ratio is actually 19.44. So is this overvalued or undervalued? Let's find out.
The poll is ready when you want me to launch it.
Or you can launch it anytime, like now also can.
Okay, so let me just launch a poll before we do a comparison. Okay, so which company would you prefer to invest in based on the data that I have just presented just now? Okay, is it Carlsberg or Heineken? Okay, so let's open it for another 20 seconds. Okay, wow, we have 40% of people voted. I'm seeing the number ups and down. Okay, very exciting, overtaking each other. So it's pretty close match.
Pretty close match,
Okay.
huh?
Yes. Okay, so a poll has already popped out in your screen.
Okay.
So let's wait another final 10 seconds, okay, before we close the poll and share the survey results. If you have not filled in yet, kindly quickly fill in. All right, cool. So let me just close the poll.
Mhm.
Let me share with you the result. All right, 61% of you voted, so it is 50-50. Yeah.
Right as
Okay. Yeah, I'm seeing the number is always like 48, 52, 51, 49. Okay, so finally ending results 50-50. Okay, from our audience today.
so, which means if you're undecided, just buy both lah. Okay. Just buy both. Okay. If you have enough capital, all right. Half of the capital Carlsberg, half of the capital Heineken. Yeah. If you can't split the two, yeah, you can actually do that. So right now we are gonna just look into the past financial records. So over here, what I find is that the average PE ratio for Heineken is 20.45, minimum is 15.94, and the maximum is 25.11. So ideally, if Heineken is where the PE ratio at that point is 16, then I would say it's actually undervalued. Anything above 25 will be overvalued. Somewhere around 20 will be just fair. So at the time, so basically right now at 1944, then I would say it is slightly below its fair valuation lah. Okay, just slightly lah, just one how is it 1 point below the fair valuation at this point of time. Now when it comes to dividend yield, what I see is that the minimum is 3.83, the maximum is 6.09%, the average is 4.83. Right now the current is 5.14. So technically speaking, all right, this is actually above its average. So I would say this is actually a good, I mean to say a little bit of a good thing lah, all right, because as an investor, what you want is that you want to buy into Heineken. The lowest amount of dividend you can accept is 4.8. So 5.1 is still slightly above 5.1 lah. And now I think I will leave it to the audience to actually decide whether or not 5.1 at this point, is this an exciting deal or is this the best deal for you? Because different people will have very different opinions about this. Okay. So now apart from comparing the current valuation of a stock like Heineken with its past, now because Carlsberg and Heineken, right, they are like competitors, all right? They are the only two breweries that are licensed to operate in this country. So you can actually take the current PE ratio of 19.44 from Heineken and compare it with Carlsberg. So as you can see over here, Carlsberg at 21.98 is a little bit more expensive as compared to Heineken at 19.44. Okay. And when it comes to its dividend yields, Carlsberg is paying 4.78%. Heineken is 5.14. So in this case, I would say Heineken actually gives out a little bit better dividend yields as compared to Carlsberg. So in terms of valuation, there's a slight edge. There's a slight edge to Heineken as compared to Carlsberg. All right. So that is how you do peer-to-peer comparison between Heineken and Carlsberg. But of course, with that said, some of you who choose Carlsberg may also have a little bit of a reason to it, simply because remember just now we actually calculated the compound annual growth rate of the earnings. So here you can find that the compound annual growth rate of Heineken is at 5.98%, whereas for Carlsberg, it is at 9.07%. So maybe there's also a reason to pick Carlsberg over Heineken, and it's due to the CAGR, because Carlsberg has a much better earnings growth at 9.07% as compared to Heineken of 5.98%. Okay, so with that said, this is how you do peer-to-peer comparison. You can take this and replicate it with Nestle versus F&N and see what is Nestle versus Nestle versus F&N and see the results. Or you can actually go into other sectors and see and actually do the same thing and compare the results. You can do it with the property industry. Like for example, you can compare, let's say, Sunway with Marsing. You can actually compare, let's say, ROI properties with Sime Darby properties, or you can actually use this on plantation, on the plantation industry, like Genting Plantations versus United Plantations, for instance. Do the same comparison, and then from there you will know which of the two do you prefer. Okay, and this kind of thing is not just based on feelings. This is actually based on real facts, real figures that have been plucked from the annual report itself. Okay, so you can actually do that. Now let's go back to the slides. So I think I have jumped the gun a little bit because I have a slide which is like this, where it says how to use valuation ratios. So I think this is a very good recap. So whenever you use valuation ratios, don't just here's a repeat of what I said lah. Don't just base your investment decision on the current PE and the current dividend yield, because that's just the current. What you want to do is that you want to compile 10 years, and then from there find out what's the lowest, the average and the high. And for PE ratio, for me personally, I like to invest in a stock that is growing. If let's say the PE ratio is between low and average, whereas for dividend yields, I would prefer to invest in a company where it gives above average dividend yields. Okay, so with that, I think I have ended my presentation session. Hopefully you've enjoyed and find this enlightening. And with that, I'm going to pass back the control to Shane. Shane.
Yes. Yeah, thank you so much, Ian, for your sharing on how to invest in the F&B stocks. Now, so what we got from this session is that F&B is a defensive industry, especially in times of like now, difficult period, tough times. So F&B may offer some kind of relief, or it's a safe haven that you can go to get some kind of use. Although some companies maybe is unable to declare dividend next year, like Carlsberg, okay, maybe because the liquor companies are badly hit this year with a lot of bars, still not allowed to operate. So we need to be aware lah. But aside from breweries and liquors company, we can also look into other consumer staple products like Nestle, F&N, Dutch Lady, or Hubsync, Ajinomoto that you've just mentioned, to look for some stability. Okay, so if you're somebody who want to who seek stability, who are risk averse, who want to seek stability, then F&B stock could be one of the options that you can consider. All right. So yeah, if any question for our speaker today, you can put in the Q&A box. We will do our best to answer. Yeah, there are a lot of comments between Carlsberg and Heineken. I feel like launching a poll. So which drink you prefer to drink? Which liquor you prefer to drink, okay? All right, so for first question is by Johnny. Okay, now if a company only has the 5 years track record, but it's growing, can we also use compound annual growth rate?
Yes, you can. All right, you can. So let's say, for example, you have 2015, 16, 17, 18, 19. Okay, so what you can do is that the base year will be 2015. So 2016 will be after 1 year. 2017 will be after 2 years. 18 will be after 3 years, and 19 will be after 4 years. So make sure when you put into the calculator, put in 4 years. Then I think it should be fine lah. But I would say because there are companies like Hubsync, right? They have growth from 2011 to 2015, but then from 2015 the growth did not sustain. It kind of like decline. The earnings kind of like trim a bit after that. So that's why that's why I tend to have a bias when it comes to using 5 years compound annual growth rate over the 10-year. I think the 10-year will be much more a reliable one as compared to the 5-year one. But also, okay, here's another note. I think this compound annual growth rate will suit very well to companies, right, that actually generates revenues from a huge pool of customers. All right, like for example, banks, Carlsberg, F&B stocks. All right, they don't just rely on one single customer for sales. All right, and this makes the AGR this formula, right, even more reliable. But if, let's say, for example, if you find a stock and then this stock it happens to achieve very good growth rate due to one or two customers, maybe they receive incremental orders from that one or two customers. The question you may want to ask is this: what if the one or two customers actually decided not to do business with the stock that you own? Okay, so this is actually something that you may want to think about and use it. And of course, with that said, use the CAGR calculator wisely and intelligently. Back to you, Shane.
Okay, yeah, thank you so much. So the next question is, would you comment on banking stocks? Okay, so this from Kexing. Okay, in terms of their operating statistic and also maybe on their valuation and your view on the outlook on the sector, please.
Okay, for me, banking sector, it depends. Okay, it depends where you are looking at. Okay, let's say we just focus on Malaysia lah, because we can't talk about other countries' banks, right? Only Malaysia, right? You can say that it is actually very exciting because the valuation of all the banks, right? In fact, most of the banks, right, they are trading at valuations which are at their all-time lows when it comes to its PE and PB. And when it comes to its dividend yield, it's at its all-time high. Simply because in the short term, maybe a lot of people don't look at banks with a favorable eye, okay? But this is exactly why value investors will actually come in and say, hey, you know what? This is probably one of the better chances to actually, if let's say you're interested in bank stocks, to acquire them at a lower price. Today I look at Maybank, like it's like 7.10. All right, last time it was 8 or 9 ringgit, and of course public bank is now at 15. Okay, you can actually check out its valuation. Don't just look at the stock price, look at the valuation, which is very important. But with that said, I'm gonna just throw in a maybe one or two golden nuggets when it comes to choosing a bank stock. Okay, because there is a huge difference between public bank, Maybank, and CIB Bank. Okay, and the key difference between how to assess, right, for me is this. Okay, I tend to look at its how I say, its gross loan impairment ratio. This ratio will tell me who has better customers. Okay, so let's say, for example, I will know that CIB Bank has a much higher gross loan impairment ratio. Public bank tend to have the lowest gross loan impairment ratio. So with that said, public bank, right, the pool of customers will be more of quality lah, means they pay back their loans lah. Okay, so that's why you can see that the impairment loss of public bank is not as severe as Maybank and CIMB Bank lah. Okay, CIMB Bank will be the worst among the three banks. Maybank will be right in the center. Okay, so with that said, this actually accentuates the importance of looking at all these metrics. Okay, because a lot of investors, they couldn't decide which of these three banks is better. All right, they do not know about this gross loan impairment ratio. So if you know how to look at this, and of course if you add on with a little bit more ratios like cost to income ratio, where public bank is most cost efficient among the rest, then from there you can actually see, oh, which of these banks is of better quality lah. And from there you can choose which one you want, which one you don't want, do the valuation ratio, buy when it's the right time to buy. Yep.
Okay, great, excellent. Yeah, a lot of people are saying thank you for your commentary on this sector. Okay, the next question is, compound annual growth rate is not really applicable to high volatility stocks. Do you agree? So if that's the case, do we have any other valuation tools to benchmark it? So this is from Wei Ying.
Okay, I'm not too sure what is a high volatility stock lah. Means, okay, you see, it depends on what kind of portfolio you want to build lah. High volatility means today it can go up, like today it can go up, and today it can go up. Tomorrow it can actually come down lah. So the question is, would you want that kind of stock in your portfolio in the first place? Okay, and that is actually a food for thought by itself. Okay, so which means, how long do you want to hold on to a stock? Okay, if let's say you're telling me, you know what, I'm going to just hold on to the stock for maybe 1 year, then of course, whatever I shared, right, may not be so applicable lah. Okay, may not be so applicable because for me, right, from my point of view, if you invest into a stock, right, you are actually taking your money, right, and park it into a company, and you are actually a shareholder of the company. And since you want to be a shareholder of the company, right, then you might as well go in for the long term lah. All right, because what you want is not just 1 year's worth of dividends. Like me, for example, I've been collecting dividends for quite a number of years. So you may want to have recurring dividend income, all right, passive income that is being paid to you into your bank account year after year. So with that, right, you may not want to have so much. You may not want to include all these volatile stocks into your portfolio. Okay, and that's why you need to reconsider what is your objective lah. Okay, because from an investor point of view, what we see is that we like a stock. We view a stock like a cash generating machine. So F&B is one of the sectors that is the type that can always produce cash, and because they collect a lot of cash from customers, and therefore they can pay out a lot of cash in terms of dividends to its shareholders. We want the kind of cash generating machine to keep on running forever, and therefore we want to buy and hold on to them forever. So that is very cash flow based of investing. But if you are looking at when you ask about volatility, maybe you're into trading. So if let's say if you're into trading, you just want to hold on to certain stocks for the short term because you're in to profit from the price difference, your buy price and your sell price. You want to profit from the difference over the short term. That one I do not know how to answer you lah. Maybe you have to find a trader lah. I heard that in the webinar session there's this market timing thingy, right, webinar that is upcoming. Maybe you should join that webinar lah. That one could be of better help to you, right, Shane?
No, if you're referring to the timing, I think it should be referring to portfolio timing. So portfolio timing is not about technical analysis, but how you can time your portfolio entry and exit. So well, that will be happening in November this year. So stay tuned for our Kentrade webinar in November. So in follow-up questions to this compound annual growth rate, we have a question from TL Ong who asked that how about compound annual growth rate on some commodity stock or even glove stock? Would it be accurate to use that as a benchmark?
You can use that on glove lah, not a problem lah. Okay, but of course, if you use the CAGR, okay, here's another trick. You can compare the CAGR with the growth of the stock price. Okay, so if you find that earnings growth of, let's say for example, you find that glove A company, okay, glove A company grows at a rate of 10% per annum. The stock price of glove A has actually grown at a rate of 50%. Then you know already it's already the stock price of glove A is already being going fried upwards already lah. That means to say, if you're going in, right, you won't make as much money as the earlier investors who bought it at a cheaper price. But if let's say the stock price of this company drop, then of course you will lose a lot more than the investors who actually got in earlier at a much better price lah. So that is what it means lah. So yes, you can actually calculate So with that said, yes, you can calculate the CAGR of sales and earnings figures for the except for Supermax. I think Supermax you can't do that. Hatta Lega, Kosan, and Top Glove, you can do that because the earnings growth rate is because the growth of the earnings of these three companies are okay. But in regards to Supermax, it's not there. So you can check back the annual reports. I already show you how to do that. Now, when it comes to commodity based, let's say you want to talk about gold mining stocks. Of course, Bursa Malaysia, I do not know whether they have any gold mining stocks, maybe Borneo.
Yeah, we have a few but they are not a very big gold mining companies. They are just, you know, the bigger portfolio is not in gold mining, and they are not so transparent yet with their minerals deposit underneath the ground.
So if let's say you're asking, okay we talk a little bit about overseas you want to talk about Barrick Gold and all this kind of stuff, then it's a bit hard to, number one, gold mining companies is a bit hard okay, because they don't necessarily have the cash flow. They don't actually generate cash flow like Carlsberg and Heineken. They don't generate sales and profits like Carlsberg and Heineken. So it's a bit hard to use CAGR So therefore the answer is a bit difficult You compile the 10 years first, then you know whether or not you should use the CAGR calculator
Okay, so there's a question from Poon. For F&B stocks, customs and duties payable may be substantial. Could you comment on this in regards to these two companies that you mentioned, Carlsberg and Heineken?
Okay, so this custom and tax typically, like for example, like sales, right? Okay, let's say you see the sales of Carlsberg or Heineken. All right, every $100, right? Every $100 in revenues, what I can recall is this: $100 in beverage sales, right, or alcoholic beverage sales. Half of it will go into custom and the excise duty, which means money to the government And then Carlsberg will take the remaining $50, right, and they will try to balance it out Pay employee, pay supplier, pay distributor, and pay shareholders with dividends Okay, so the risk is that yes, the Malaysian government may or may not increase the excise duties or the custom rates, all right, and this will actually impact the profitability of the brewery. But if you want to say, okay, if you want to say when, I do not know when. Okay, I do not know when it will happen. I do not know will it happen, when it will happen, and this kind of things is very hard to say, because if you want to talk about Malaysian politics, it's again very uncertain, isn't it? Okay, it's so it's as uncertain as the Malaysian political scene. All right, so who knows? So the question is, but then I think a more important question would be, despite, if let's say this thing happens, right? Do you think Carlsberg and Heineken, number one, is the management in place, right? Can they tackle this issue? That's number one. Number two, is their finances strong enough to cope with this issue? So if let's say the answer is yes, the management is strong enough to take care of this issue, and the company's finances, the cash flow is strong enough to deal with it, then okay then I would say still okay Because if let's say it will be very funny to buy into a F&B stock and then say, oh, something bad happened to this company, and then the stock collapse. Then of course, then you may want to ask yourself why you want to invest in this F&B stock in the first place The financial position of the company must be so resilient and robust that it can, even if there's, in the course of during the business, right, there will be good news and bad news So if they can survive in all of these conditions, right, then this is the kind of company that I may want to invest into So Shane?
Okay, now this is a question from Hui Lip. So can you comment on this company Nestle? Because right now Nestle is like a matured company, and then but the share price is very high, like 140 range. So do you think they will have room for a more appreciation, and should we consider Nestle?
We don't. Okay, the consideration is based on valuation ratio lah. All right. So the thing is this lah. All right. So if you want to like consider Nestle, first you do all the stuff that I've just mentioned in the webinar today. All right. From there you will find out the compound annual growth rate and stuff like that. Do the valuation ratios. Then from there you will know, oh, the valuation ratio, let's say is a figure. Then you take this figure and then you compare it with, let's say, Carlsberg, Heineken, F&N, and then you see which one is a better deal. All right. So if let's say Nestle is at a high price, then you may want to think, is this worth it? Is this worth it as compared to other stocks? So stock investing is about, there are like 900 stocks in listed on Bursa Malaysia. So I think it will be good for investors to keep shopping around, all right, and find out which of these deals are the best for you. You don't have to, if let's say Nestle is too high, then you don't need to actually invest in Nestle. There are so many other choices out there.
Okay, so the next question from Jasmine. Let's say if I found a company, two companies that I fancy, but they are belonging to two different industries. Is it possible that to use this kind of peer-to-peer comparison for two different industries?
It depends on what are the two industries lah. Of course, you can't actually make a meaningful peer-to-peer, but you can compare based on valuation. So valuation you can compare.
Okay.
Yeah.
Oh, okay, cool. As a dividend investor, what is your view on the oil and gas stocks since it is cyclical and volatile in nature? So this is from Minnie.
Which is why I don't touch into them.
Okay, so oil and gas is not your favorite pick lah. Yeah, because if I understand you are dividend, so you will pick more the companies that provide more stability. Am I right?
With that said, of course, everyone will hope. I mean, all dividend investors will hope that, let's say, Dialog, please come down or something like that, but that may won't happen. But then the thing is this lah. I mean, with that said, there are so like for example, Petronas Gas is one of the companies that pay very steady dividends for quite some time. Okay, so these are the only few choices that we have lah. But oil and gas service, you see, oil and gas service companies most of the listed oil and gas companies in Malaysia are oil and gas service companies to serve, let's say, Shell, who else? Petronas, okay, and all this kind of or Total or any of this kind of major oil and gas exploration companies. So the question is this: oil price is volatile, all right? If oil price go up, all these exploration activities they will increase, and therefore increase the demand for oil and gas services. Okay, so if let's say the growth is based on this, then what if the oil and gas prices actually drop? What will happen to your investment? Okay, so that is actually the key question. So if let's say you couldn't answer this question in greater clarity, then of course it's best for you to not invest lah. All right, for me, because I want very what do you call consistent dividends, so I don't think I like to see my portfolio going on a yo-yo lah. All right, so for oil and gas companies, what is more important if you are into it? You have to check the contract. All right, because it's all based on contract ma. All right, if let's say the oil and gas companies have a lot of contract, then very good lah. It should actually sustain the revenues for at least 1 or 2 years lah, or maybe 2 or 3 more years. But then what if after the 2 or 3 years, the oil and gas companies don't have, or they did not secure any contracts, or they did not secure enough contracts to facilitate, let's say, continuous growth in the CAGR, then what will happen to your investment? So this is something that you may want to consider. So Shane?
Okay. The next question is by Jovin in relations to the REITs, real estate investment trust. So do you think that the shopping mall and hospitality REIT will go back to normal performance post COVID-19?
This pandemic, right, is unprecedented. Like what most people say, it's the first time everyone will see lah. Okay, so this is actually very exciting times. All right, so for me, right, of course, I wouldn't say the hotels will just suddenly go bankrupt and goodbye lah. Okay, I don't think that will happen. That is why we need to look at financial position of these REITs very closely lah. Okay, so for example, let's say of course, let's say if you are looking at Malaysian REITs, like hospitality REITs, there's only one, right, which is YTL Hospitality. So the sponsor is YTL. So the question is whether YTL will go bust lah, all right, or whether YTL's all these hotel, you see, they get YTL Hospitality REIT, they get rental income from, let's say in Malaysia and Japan, they got this subsidiary lah. Okay, not subsidiary. Okay, how do I explain this? Except for the Australian hotels, the Marriott hotels in Australia, the ones in Malaysia and Japan. Okay, so they own the hotels and then they lease it to the what they call another YTL company lah, which is not related to YTL Hospitality REIT. Okay, and these companies, right, they will manage and they will manage the hotel and then they will pay rent to YTL Hospitality REIT lah. So so if these companies are not doing so well, all right, and they are struggling to get finance, they're struggling to get money and stuff like that. So what happened, lor? Okay, and of course that has been answered last 2 months, where YTL Hospitality REIT has actually restructured the rent, so therefore that causes the stock price to fall a bit lah. All right, but with that said, it depends on, actually, who knows COVID-19 how long it will last. Nobody will know one. So let's say, for example, if it prolongs until all these hotel companies, they cannot tahan already, they go bust, then too bad lah. All right, then too bad the stock that you own cannot tahan lor. But I would say some of these stronger companies, especially with backings, with very strong financial backings, maybe they will last a bit longer lah. Hopefully they outlast the COVID-19 situation. Coming back to shopping malls, I think shopping malls right now, because of RMCO, I think like for example Sunway, Pyramid, Mid Valley, and all these places, these are places people still go there, you see. So they are more likely to survive more resilient than the hotels lah. Okay, so I would say the shopping malls will not, okay, if let's say COVID-19 were to continue on for many years to come, I would say the hotel will die first lah. The shopping mall will still survive. But if let's say COVID-19, but this is all speculative lah. Nobody knows lah. Okay. So what I see is that hospitality REIT, right, is for people. I mean, not just Malaysia, but also Singapore. Because right now these hospitality REITs are actually offered at a very cheap price. So some people, if they want to like get 10% dividend yield, right, after post COVID-19, they're just hoping that COVID-19 is there's no more COVID-19, everything is hunky dory. Then maybe because of the price they get, which is at a super crazy kind of a discounted value, maybe they can get 10% dividend yield after that lah. But who knows? It's for people who place lah.
Okay, yeah. So let's do one more question, which is from a few of them asking if you are able to share with them your Google Sheet. Do you want to do that?
How to do that?
How to do that? If you want, I think they can email you lah. Then you will grant the access. I'm not sure if you want to do that. So this is just some requests. from a few
Yeah,
people.
yeah, sure.
Oh, all right, cool. So the speaker Ian has decided is willing to share with you all the Excel sheet, so you can you know, text them, email him afterwards. Then he will share with you the access to that. Okay, so this will be very helpful if you want to have a template that can you know, that can allow you to benchmark the historical financial performance of a company. All right, so let me just take back the control as the presenter and tell you more about what is next for you. Okay, just give me a minute. Thank you so much, Ian.
Hey, no problem.
All right, so right now we are done with the Q&A. So yes, account opening. All right, so if you have not had a stock trading account and you want to open one, you can fill up this form, kentrade.com.my/open-account-form. So fill out this form with your contact details. The friendly dealer representative from Kenanga will contact you to get all the necessary details to help you with the account opening. So if you already have a trading account and if you want to have one more trading account with a different bank, which is like Kenanga, okay, you can also fill out this form to open an account with Kenanga. Okay, the friendly broker will arrange a dealer reminder to a dealer representative to serve you. So our next webinar brought to you by Kentrade, which is how to profit from chart patterns in Malaysia stocks. Okay, now today's session is essentially more FA driven, more fundamental driven, where we look at the PE, look at the dividend yields, look at the historical earnings, and to see whether there's any growth in terms of compound annual growth rate. For the next webinar brought to you by Kenanga, it will be on technical analysis. Okay, so we're going to look at chart patterns. So this session will be conducted by Mr. Derek Tan from Singapore. So the date is 13th of October, which is a Tuesday. So it's happening at 8:30 to 9:45. So the registration link is also is already put inside our chat group. So you can click on the link to register for our next webinar, how to profit from chart patterns in Malaysia stocks, to learn more about technical analysis. Okay, so thank you so much. If you want to reach out to Ian, you can email him at ian@kclau.com, and just mention that you want to have a copy of this Google Sheet. Okay, so thank you, Ian, for generously sharing your template with our audience today. So yeah, so that's all from us from Kenanga Investment Bank for this webinar, F&B Stocks Powertalk. Okay, so thank you everybody for tuning in. Thank you, Ian, for joining us as our panelist today. So I will see you all in October for our technical analysis workshop webinar brought to you by Kentrade. All right, with that, this is Shen Chu signing off. Bye bye.
Bye bye.